Welcome back. I'm super excited to have you here today because, well, we're looking at a genuinely fascinating market mystery. Imagine finding a stock right before Wall Street even starts paying attention and then, seemingly out of nowhere, watching it go absolutely parabolic. So let's just dive right in because today's explainer is all about a relatively unknown medical technology company called Haemonetics. They trade under the ticker HAE. Now, they've been kind of quietly operating in the background of the healthcare sector for a while, but recently, their stock chart just exploded, and it's left a lot of investors asking, okay, what exactly is going on behind the scenes? I mean, just take a look at this massive 92.7% one-year return. That's a huge number, right? But honestly, what's even crazier is the sheer velocity of this move. Haemonetics didn't just slowly grind higher over 12 months. No, it jumped nearly 20% in just 3 trading sessions during this wild stretch in mid-August. We're literally talking about the stock closing around $90 on August 17th and then shooting past $108 by August 20th. Moves like that? Yeah, they're definitely designed to grab our attention. So why is this unknown stock exploding? That is the million-dollar question, isn't it? What makes this surge so incredibly intriguing is that we aren't talking about some speculative crypto token or a hyped-up AI startup or, a meme stock fueled by Reddit. Haemonetics is a highly specialized, really niche healthcare equipment company, and yet Wall Street just suddenly fell head over heels in love with it. To figure out why all this institutional money is flooding in, we've got to look at what they actually sell. At the very core of their business, Haemonetics is a leader in blood and plasma management technology. To be specific, they develop the equipment and all those disposable products used during plasma collection, and this is anchored by their flagship platform, which they call the NexSys PCS system. Now, you might be wondering, why plasma? Well, because plasma isn't just some basic commodity. It's a critical, essential biological input. It's literally the raw material used to manufacture life-saving therapies for patients dealing with immune deficiencies, bleeding disorders, and a whole host of other serious conditions. The demand for the stuff is structural, and it's definitely enduring. And this builds into a seriously attractive recurring revenue engine. See, Haemonetics doesn't just sell you a plasma collection machine once and say goodbye. Step 1 is installing that NexSys PCS technology. Step 2 is embedding it right into the clinic's workflow. Step 3, and this is the kicker, is selling the single-use consumables required for every single plasma draw. That leads us straight into Step 4, predictable, highly lucrative recurring revenue every single time one of those machines gets turned on. It's brilliant. Section 1, the CSL Plasma Catalyst. Now, while the recent supply agreement with industry giant CSL Plasma grabbed all the shiny headlines, that CSL news wasn't actually the original spark. It was really just the accelerant. Haemonetics was already picking up some serious momentum thanks to their underlying business metrics. In their latest reported quarter, they posted a really solid $339.4 million in revenue. But check out that adjusted EPS, $1.14. That absolutely crushed the 87-cent expectation from analysts. And on top of that massive earnings beat, management confidently raised their full-year revenue growth outlook to between 5 and 8%. The business was already firing on all cylinders well before the CSL partnership even hit the newswires. When you map this all out on a timeline, you can see exactly how this compounding momentum created that nearly 20% explosion in just 3 days. Look at this. On August 17th, the market is digesting those strong earnings and the raised guidance. The very next day, August 18th, boom, the CSL agreement gets announced, and the stock rockets almost 16% in a single session. By August 19th, Wall Street analysts are scrambling to upgrade their ratings and price targets. And then by August 20th, the stock is pushing intraday highs near $110. It was essentially the perfect sequence of positive data points, creating a really powerful feedback loop. Okay, but here's where I want to pause for a second. Let's take a collective breath, tap the brakes on the hype train, and look a little bit past those flashy headlines. Whenever a stock moves this far, this fast, we really have to dig into the reality of the SEC filings. It's time to read the fine print. The absolute most crucial point here is actually hidden right in the company's official disclosures about the CSL deal. The agreement is explicitly non-exclusive, and it contains, quote, no minimum purchase commitments. I really want to emphasize that for a second. The market traded on this announcement as if CSL had just guaranteed billions of dollars of revenue. But they didn't. This is a commercial opportunity. Sure, CSL has the ability to adopt the technology and buy all those disposables, but the actual financial impact, that depends entirely on actual future adoption. It is not a guaranteed contract, and honestly, that's a massive distinction to keep in mind. Section 2, the valuation warning. So a great company can still be a terrible investment if you end up paying way too much for it, right? And right now, investors are definitely paying a premium. This 53 times price to earnings ratio gives the company a market cap of roughly $4.95 billion. Let's be real, a PE in the low 50s is not exactly a bargain valuation, especially for a company projecting 5 to 8% revenue growth. It basically means the stock is now priced for absolute perfection. When you're trading at 53 times earnings, there is zero room for error, zero room for delays in that CSL rollout, and absolutely zero room for an earnings miss. Furthermore, this explosive rally completely changed the risk-to-reward ratio. Just look at where the stock is trading right now versus where even the most optimistic analysts think it's going to go. With the current price hovering right around that $108 to $109 mark, the stock has essentially already met or even exceeded the very price targets that analysts just raised. BTIG bumped their target to 110. Baird raised theirs to 119. I mean, when the stock was sitting at $70, a $100 price target represented some massive upside. But when you're buying in at 108, a $110 target leaves you with very little meat on the bone, and a whole lot of downside risk if that momentum happens to shift. So we've got this fascinating tug of war happening here. On the bull case side, you have basically everything an investor could want, right? You've got accelerating recurring revenue, a major new partnership with a giant like CSL, crushed earnings estimates, and just undeniable momentum. But then on the bear case side, the reality is a bit stark. You're looking at a 53 times PE valuation that demands absolute, flawless execution. You have an SEC filing confirming exactly zero guaranteed CSL revenue, sky-high market expectations, and a stock that has already run incredibly hard over the last year. If you're going to follow this story, there are exactly 5 metrics you absolutely must watch in the coming quarters. Basically, forget the daily noise of the stock price and watch the business. First up, is plasma revenue actually accelerating? Second, is that highly profitable consumables revenue becoming a much larger piece of the overall pie? Third, are these new revenues actually translating into operating margin improvements? Fourth, is the company realizing real free cash flow from their accounting earnings? And fifth, honestly the most critical one of all, what is the actual verifiable adoption rate of those NexSys systems over at CSL? Like, how many machines are actually plugged in, and how many disposables are they actually buying? Haemonetics has successfully engineered the kind of real business developments that can create a genuine long-term healthcare compounder. They have absolutely captured Wall Street's attention, no doubt about it. But the question I really want to leave you with today is this. Can Haemonetics actually earn its new valuation? The flashy headlines got the stock to $110. But now the real test begins to see if the cold, hard business results can catch up to those overheated expectations. Keep a very close eye on those filings, and as always, keep learning. Thanks so much for exploring this explainer with me today.